Hello and welcome to our latest Insider interview. Today in the studio I have with me Nick Train, Fund Manager of the Lindell Train UK Equity Fund and the Finsbury Growth and Income Investment Trust. Nick, thanks for coming in today.
Kyle, it's a pleasure, or I think it might be a pleasure. I'll tell you in 25 minutes' time.
A lot of our viewers will be very familiar with your investment process, but for those that are not, could you summarise it?
To me, it's about trying to keep things simple, trying to, in a sense, behave well. And by that, I don't necessarily mean morally well, although I hope that that's also the case. We try very hard not to trade too much. Everybody knows that that's a detractor from value. We try very hard not to diversify our portfolios, letting them get cluttered by too many ideas. Keep things simple. And we also try very hard to avoid knowingly investing in speculative or low quality investments. And what I've found, I have to say not over the last couple of years, let me just put that in there, but what I've found is if you follow those three simple tenets, don't trade too much, keep things concentrated and focused, and keep investing in high quality businesses, then over time, good things can happen for you.
So the fund and investment trust that we're focusing this interview on invest in the UK stock market. Now, UK equities have been out of favour for several years now, pretty much since the Brexit vote. Why is the UK so unloved, and what needs to happen for that to change?
I agree with you. I mean, it's been such a frustrating few years as a career-long UK equity guy, which I am. And, you know, there are so many theories about why the UK's been so disappointing, and no one's got any resolutions or answers to it. I have to say, I think when you look at what's worked globally over the last 5 years, of course it's been either big tech, digital winners, or it's been luxury. Of course, you know, we've seen the French stock market for a brief period of time nudge ahead of the UK in terms of its market cap because France is the home to Vuitton and Hermes and others. And I suppose you have to say, if the UK had either had a true global tech winner, or preferably two or three, an Apple say, or it had had a heritage luxury stock, maybe people would be feeling more enthusiastic about this market. I think to me that's the absolute nub of the issue. I would say, though, that if you look just underneath, let's say, the top 10 or 15 biggest companies in the UK, actually I think there are reasons to be encouraged, because there are a number of, in our opinion anyway, true globally significant tech winners in the UK, and we're invested in some of them, and also some, if not luxury, certainly premium product companies also invest in the UK, which, well, all of those that I'm alluding to us look undervalued, and maybe global asset allocators are missing a trick if they don't come back and have a look at this market in more depth.
The UK market has a rich dividend heritage, but income seekers, they now have more choice due to those interest rate rises that have been taking place since the end of 2021. You can now get around about 5% on cash and also on certain types of bonds, such as short-dated UK government bonds known as gilts. So how would you make the case for UK equities versus those other assets which are considered lower risk?
Well, I think I would say never invest in equities for income. If you need income, then as you wisely remarked, there are many other assets that you can turn your attention to. But you invest in equities for, however trite it sounds, long-term protection of the purchasing power of your capital. And if you're more than a bit lucky, some real growth as well. I think it's so important to make this this fundamental observation. I hear people saying, should I be investing in gilts? Should I be investing in cash deposits? Listen, the best investment to make is backing honest, smart, hard-working people with a good idea. Do you know what I mean? That's what really makes you money, investing with capable, honest people who've got a good idea for a business. And I still think, notwithstanding what we've just said about the UK stock market, we are fortunate that we live today in what is still an open, fair, business-oriented economy. And I said, it's a shame we don't have an Apple. And it is, but a bit of that truly, I think, is bad luck. You know, there's enough research going on in our universities, there's enough people starting up businesses in all fields to make me believe in 10 years' time we'll look back and say, that was just a blip for the UK. This is actually an entrepreneurial, honest, business-oriented culture. And you ought to make money investing in that culture.
And just following on about your point about income, in a recent note to investors, you made the point that several of your companies, you think the share price would be higher if their respective boards focused on maximising organic growth over dividends. So could you elaborate a bit more on this? Does this reflect that you think the thirst for income among investors is over-prioritised by some companies?
There's a variety of explanations for why the UK stock market has been disappointing. One of them, I don't think it's the only one, is you could arguably blame my generation of professional investors. I'm not going to say how old I am, but I was active in the market from the early 1980s onwards. And there was a quarter of a century, probably, maybe even slightly longer, there was a quarter of a century where investing for income really worked in the UK stock market. And I was part of that period, and like a lot of professional investors of my vintage, got into the way of thinking that all you needed to do was invest in a share on a reasonably attractive dividend yield and tell the board to keep growing the dividend at all costs. Yeah, we got into that habit. I think in hindsight, and the lesson of the United States, the lesson of NASDAQ is there for us all to see, is that is a destructive way for companies to run themselves. Companies, we want them to focus on organic growth opportunities. And if that means investing all of the earnings and not paying out any dividends, that's really what we need. And so maybe there has been a cultural issue for the UK. I hope perhaps it's changing a bit, even at a individual stock level. You mentioned what I wrote in the report. We've had really candid conversations with senior executives in some of the companies we're invested in, questioning the dividend policy. And in some cases, I think I'm pleased to say, they've either slowed the rate of dividend growth or in some cases not grown the dividend at all, reinvested more in the business, and we've seen some better outcomes as a result of that.
So let's move back to the way that you invest. So as you mentioned, you seldom trade, you buy and hold for the long term, you look for high quality growth businesses. In terms of your existing holdings, how often are you taking profits or do you continually run your winners?
Barely ever. You know, I think your terminology is exactly correct. The effect, and I mustn't say it more strongly than this because I don't have a lot to shout about at the moment, but okay, we're all trying to do our best according to a set of investment principles and approach. But absolutely at the heart of what we're trying to do is identify winners. That's not so easy. Identify winners and then run them. Because when you look back over history, and I'm talking decades, it's amazing how well companies and share prices do if you forget about the 2 or 3 year noise. You can suddenly look up 10 years later and think, my God, I almost without noticing, this thing's trebled. That's the sort of effect we're trying to capture. Is there anything wrong with taking your profits and reinvesting. No, there's nothing wrong with it. Is running your winners and not trading the edges of your portfolio always right? No. No, I can demonstrate it's not always the right way to do it. What I would say though, for us, one, it works with us kind of psychologically because it's what we want to do. Two, the one thing for sure about the sort of activity you're talking about is that it's costly. You know, there are transaction costs involved in taking profits and reinvesting, and what you're reinvesting has to do as well as what you've sold. And I figure that just at the margin, with no guarantee of superior performance, but just at the margin, doing as little as we do keeps more pennies within the portfolios, keeps more pounds over time within the portfolios. That's all I'd say.
The fund and the investment trust have around 20 holdings. Do you have like a universe of stocks that you think, you know, I've got 35, 40 stocks that I could select if the price is right, for example, or do you not think about it in that way?
We absolutely do think about it in that way. And you're right, there are roughly 20 holdings currently. There's easily another 15 that we could access. Question is always though, by the way, let me say this, going back to how we do it. The other thing I think it's important is to be fully invested all of the time. So when people entrust their savings to our equity strategy, I don't want to hold cash for them. I'm assuming they've sorted their cash, their income requirements out somewhere else. They've come to us, the equity market, to own equities. So I'm fully invested all of the time. So I maybe have 15 other interesting ideas, but I've got to be sure they're more interesting than what I currently own. Because if they're not, then I'm just shuffling deck chairs on the Titanic. No, I don't mean that. You know, I'm just shuffling assets around and costing my investors money. I do think, you know, there's such an emphasis in this business placed on what's your next idea? What's the novelty that you can show me? Have you done something for me over the last quarter? And, you know, grass isn't always greener. You know, sometimes it is best to stick with what you already own. Anyway, that's our mindset.
So that leads on to my next question. When was the last time you had a new idea?
An actionable new idea?
Or a new idea that could be on the substitutes bench that you could one day invest in?
Well, I'm going to be coy and a bit of a tease. We're currently actioning a new idea for the UK strategy. We initiated it about 3 weeks ago. It's a company that we first seriously looked at about 8 years ago. We've monitored it ever since. Maybe it would have been better if we bought it 8 years ago, but it definitely wouldn't have been better if we bought it 5 years ago. It's done nothing for about 5 years. The stars aligned and this seemed like an interesting time for us to initiate a new holding. That's the third new position in this UK strategy since 2020. To me, that feels quite active. But I guess for most professional investors, it would seem like lackadaisical inactivity. But, you know, just to give you an idea, so I guess that's one new idea every year, something like that on average.
Nick, thank you for your time today.
Well, Carl and Jules, thank you, and your viewers.
So that's it for this episode. You can check out the rest of our Insider interview series on our YouTube channel. You can like, comment and subscribe, and I'll hopefully see you again.